Hello. I'd like to welcome everybody to this SuperReturn Spotlight Webinar. How will Europe's VC landscape look in 21 and beyond? So first of all, it's good to see that we have so many registrants and participants here in this rather, I would say, traditional webinar format in a time where Clubhouse is the big hype and everyone is running there. So thank you in advance for that. Just that we make it clear, we want to still have it interactive here. We will have at the end of the session a dedicated Q&A round, so there should be enough time to ask and answer questions. There is an Ask a Question button on your screen, which you can use for that. So it's about the European venture capital ecosystem, state and the future today. I mean, what we hear and see is that more and more capital is going into the market. There are more and more companies being created and successful companies. We have more and more exits, what we see in the market, both trade sales and IPOs. Well, recently even the weird stuff of the SPACs, we may get also to that. So, and we are in a pandemic. Well, we don't know whether we are in the midst, whether we're getting out or whether we're getting to the wave number X. But the performance we see in the market is very interesting in these times. Therefore, we want to dive deeper into this topic, especially to analyze how sustainable the whole market is we are right now in. To discuss this topic, I think we have a very distinguished panel gathered here. You may know already most of them. We have a good mixture of LPs, of GP, and the founder perspective. So there should be everything in the session. So I make a brief introduction here. First of all, I look at my screen. So from the upper left, which is Holger Rossbach. Holger Rossbach is a director, senior director, exactly, and private investments at Cambridge Associates. Cambridge Associates is a global investment firm headquartered in the US and active in the venture business for, I think, since the 70s. So there is a lot to contribute from Holger based on the experience as they have insight globally in this asset class. We move on to Bjorn, to the right on my side. Bjorn Tremmerie, he is head of ICT and business angel investment at European Investment Fund. Well, the EIF, who is part of the European Investment Group, is by far the largest and most relevant venture fund investor in Europe. To give you a number on this, over the last 25 plus minus years, the EIF has invested in more than 1.5 million small, medium enterprises, well, usually indirectly via the VC firms. And then Nenad Marovac, he represents the GP here in this round. He's founder and managing partner at DN Capital. DN Capital, global early stage investment firm, venture capital firm with offices in London, Berlin, and San Francisco. So he also has a global perspective on venture capital. And I think just recently, he's very much characterized by having Otto in his portfolio, going public recently in Frankfurt and traded above 10 billion in valuation. So maybe, yeah, you see the proud guy. He for sure he deserves this, but for sure he can contribute a couple of insights on that later on. And then last but not least, we're happy to have a founder here, Stephan Rohr. He's managing director and co-founder of Munich-based startup TWAICE. TWAICE, founded just not even 3 years ago, is, well, I would say, one of the hottest startups in town. What are they doing? TWAICE provides predictive analytics software to analyze and optimize batteries for the mobility sector as well as for the energy sector. So this about the panelists. Well, I myself, I'm Ingo Potthof. I'm partner and founder of UVC. We are an early stage venture capital firm based in Munich. We invest globally, and I'm your moderator for this session. So now, finally, we can get started. So I briefly mentioned the pandemic. I don't want to get too much into the details, but I recall, Holger, almost exactly 1 year ago, we were at Super Ventures, sitting on a panel. The world was bright and some coronavirus was creeping into the room from China. We've seen it in Italy and heard it. And on the panel, we said, well, this could be a crisis. We did not know back then. How would you look back, on your thoughts back then and the development, just to summarize this development?
Yeah, what a massive journey, right? I mean, no one, to your point, during last Super Venture would have predicted what has happened then in the following 12 to 14 months. So a real massive change. Currently on the VC side, it is what we've observed at the very beginning, being on the LP side of the table, is that it was about quick period of really like everything got frozen. It was the shock type of moment where no one did move, no investments, no meetings, no one knew what's going to happen to the existing portfolio companies, what is happening to the existing business models, to cash burn rates and the usual. That was really very much an inbound type of moment where people were really much more focused on, so GPs were focused on themselves, founding teams were focused on their business models and their startups. Not a lot did happen with regards to our industry. And the big surprise actually was that so many processes were sort of dragging over and were pre-prepared before, and were sort of ready to go before the first lockdown happened. And as soon as this first sort of lockdown went over and there were very sort of small signs of the horizon that things over last summer would be back to normal, I actually do think that the VC industry was really very much at the forefront of like having the traditional spirit of founders being optimistic, looking ahead, and trying to make the best out of being flexible and making the best out of it. I think the amount of deals we've seen around summer, especially post-summer then, was massive. Post-summer was totally crazy. People were really getting used to the whole situation. Of course, some of the business models had a tough time. Tough calls here and there had to be made on a selective basis. But overall, and I guess we will talk about that in more detail in a second, volume was back massively post-summer, and prices were like on a holy moly, on a record level back, especially post summer break. So a very, very much up and down type of year within 12 months.
Okay, maybe Stephan, just from your perspective, I mean, you're the founder at the front of the business. How did your customers and your industry react? I mean, how much did it affect your business?
So I think it's also changed over the course of the last 12 months, right? It was various phases. I think it's you also have to consider that we currently really focus on B2B, right? I think it's much different when you are in the B2C industry. For example, there are some selected models like in the e-commerce space which highly benefited immediately from it. But when we are focusing on the B2B side, we saw the same actually as in the VC side of things. that it was really like the frozen situation. So every customer at the very first moment stopped really like the outflow of money and really wanted to figure out where is the outflow of money, and to really make sure that to decrease the burn rates and so on. But then actually, as passing the lockdown, the first one entering the summer, we also see that actually it already started again, that the companies, all the enterprises made up again, released their budgets. And actually at the end of last year, we even saw some kind of like increases in terms of like spendings of the major companies on certain topics. So I think the overall the 12 months accelerated definitely some special topics like digitalization. I think it was pretty clear now that they have to do it. On the other hand, also in our industry, electrification, I think it gets also much clearer that it's the path to go. And also like some topics like sustainability. And I think now, like the last 6 months, we saw quite heavily spendings of companies in that areas. And that, of course, also, for example, affected us. And due to that, we're did quite well in Q4, and also now having a very strong 2021 ahead. So I think it was really this phases of really frozen completely and then opening up again and reinvesting in the stronger megatrend topics, I would say.
Mm. But Nenad, are we now back to normal? I mean, do VCs deploy capital based on video calls? Is the deal flow you're seeing like ever before, or stronger, weaker?
Yeah, it's an interesting point. It's definitely interesting times, as they would say. And just going back to just reiterate a little bit what Holger and Stephan said, but I think in March and April when this first hit, and I was also at SuperReturn, and remember, like, do I shake this person's hand or not, or do I just elbow or whatever? But you know, I don't know if anyone was there at you know, the Ian Osborne party, where I walked out of there thinking, oh my God, that was crazy given this virus. But anyway, coming back to what we're talking about here. I think the first 2 months, all of the VCs, we kind of just went, whoa, what do we do here? Because we had to do a triage on the portfolio. Okay, which companies are hit, which companies are doing okay. And then we basically built cash flow models for each company going all the way till December 31, 2021, and made sure all the companies were financed until that point. And then once we got done this work, which took us about 2-3 months, then we said, okay, where do we want to invest? And we kind of had we came up with 2 ideas. One, we want to invest only in companies that are COVID resistant in the short term. So obviously, we're not going to be doing a travel deal or events deal unless it's digital right now. And then also looking at companies that will benefit from this digital transformation. And I think that you know, one thing that we all know, and the fact that we're sitting here on this platform, is COVID has accelerated the digital transformation that we've all been investing in. And so you know, if you're running a factory, you're using software automation, robotics, and you're using even more of that now because you don't know if some people can't come to work because they have COVID. If you have kids at home that need tutoring, you're not having tutors come to your house. Everything's moving online. If you're single today, how are you going to meet someone? You know, there's no parties, there's no bars, so you move to online dating. So hence, you look at also you know, companies like Bumble that just went public for $13 billion. If you also want to get around, you probably want to have a car. Hence, Carvana, now $50 billion company. Auto One now worth $11 billion. Same thing, used cars. The demand for used cars has gone up tremendously as a result of COVID and people not wanting to take public transportation, et cetera. So I don't think things are normal. I think we're in this bubble now, and I think we're going to be in it for a while. And so there is a new normal. And I think more and more things will move online at a more accelerating rate. And as you can see in the stock markets, the capital markets think that's where it's going too. But how long this can last, I don't know. Some of these valuations are mind-boggling. So we're definitely in an interesting time.
Yeah, sure. But Bjorn, so I'm sure you are representing a governmental investment entity, not just looking at profits, but looking at foster the ecosystem. You probably had been initially concerned But now looking back, I mean, it was a record year of venture financing across Europe. 40 billion has been invested in startups or venture finance companies in total. I mean, it looks great. So do we have enough capital now? We were complaining many years there's not enough capital in Europe. So are we on the right track here?
We're definitely on the right track. And before going deeper in that, I would just like, from my perspective, comment one thing on what has been said up until now on the COVID crisis, just for the benefit of the European venture market in general. Because EIF has been investing in European venture for the last, via funds, for the last 25 years. We've witnessed 3 crises: the dot-com crisis, 2000, 2002, the global financial crisis, 2008, 2010, and then now the pandemic. There's one thing that we have observed, we have more than 300 GPs in our portfolio active in venture. The quality and the reactivity of our European GPs to this crisis has been nowhere to what we've seen before. It's been second to none. Everybody knows the famous Sequoia letters of the dot-com crisis, the global financial crisis. Now it seems that every GP in my portfolio, in the venture portfolio, had experience and had a disaster plan ready in the shelf to roll out. What you referred to, Nenad, we saw that you immediately went to, okay, stress tests, what here, where's the triage that we need to make? Literally within 2 or 3 weeks of the lockdown, we had from all of you, from you, Ingo, from Nenad, from everybody else there, we had a COVID overview. What is it that we're going to do? What is it that we think will happen? Where's the weakness? Where's the strength in our portfolio? Where do we have cash buffers? What's the impact on our fundraising? What's the impact on the fundraising for the companies? I would want to give, with a Strava term, a big kudos to the whole GP community out there in Europe, because you've done tremendously well. I can compare with the dot-com crisis. I can compare with how you reacted during the global financial crisis, and you've really nailed it this time around. So I want to say really well done for all of you GPs out there, because it's thanks to this experience that we can show that the European maturity of the ecosystem is really there. So then on your question, is there enough? Well, one could say, yeah, glass half empty, there's never enough, but one could say as well, glass half full. Yes, there are segments of the market that are getting funded. There are segments of the market that if you have a good idea, typically you will get your funding in Europe as well. If you look at what gets funded now, there's a lot of funding that happened, but if you looked at where the funding was going is in the more mature companies, the larger rounds, there was less funding happening at the real seed and stage, company creation stage. Although typically that's a segment that if it were not for COVID, that typically would be sufficiently funded. So we saw that, yeah, the winners already, the identified winners attracted a lot of money, and they are perhaps considered as safe bets. But normally that would be the segment where I said in Europe we would be able to do more. Because currently on the growth stage, there's a lot of funding available, but there's not a lot of funding available coming from purely European players. So I don't want to make this a political or geographical debate, but normally this would be a segment where I think we should be doing more. But even in the current environment, I would say if you have a good idea, you will get your funding. I have seen that you guys, the GPs, have moved to online due diligence. The same way as the whole world moved to online consumption, to online collaboration tools, online dating, as Nenad said. GPs and startups are also doing online dating. Even we as a European institution, we're trying to do the online dating with the GPs. It doesn't go to the full extent that we try to invest in a first-time team that we've never met. That will still be a bit difficult because we don't have any product that we can analyze our due diligence on. The only asset that we can due diligence on is people. And before we write a 10, 20, 30, 40 million check, I think it makes sense that you at least try to be in the same room with the team that you work to back. But other than that, I think in the midst of the crisis, the venture capital business in Europe is functioning from the GP to the company side and from the LP to the GP side.
But you mentioned the US investors who are deploying more and more capital, are involved in more and more financing rounds, not even at the very late stage. They're going to be in Series A. Principally, that's good, but are we too dependent possibly on them? So do we need more German growth funds or German European growth funds? Or do you think, I mean, of course, most important is that we have the capital, but what's the IF perspective?
Well, again, first of all, we're grateful that we can have, after 20 years, this type of debate, and that we don't need to have a story saying that there's no funding available. So it's fantastic that you see all the growth players from all over the globe now identifying the same opportunity that we have seen coming for the last 10, 15 years. So that's good. But I just think that from a European policy perspective, you want to make certain that you're also capable of surviving on your own. So I'm not saying that we're too dependent, but you just want to make certain that if the tide were to turn, that, for instance, there is no valuation advantage in Europe any longer, and the technology would, for one instance or another, not anymore be the flavor of the day to invest in European technology, that we still have an infrastructure in place that can support our European champions as well. I think that's a duty that we would have as a policy player. So I'm not saying that we don't welcome the non-European funders. On the contrary, they're vital for the ecosystem as well. It's just if you're fully dependent on it, you become vulnerable. And I think from the policy aspect, we want to avoid that we're becoming vulnerable in critical segments. And critical segments, the growth segment is indeed a critical one. Sorry, Nenad, so you wanted to comment as well, so I want to...
Yeah, I'd like to comment on this. I think the US players like Sequoia, Bessemer, and all these other players coming into the European market is just fantastic, right? It proves that European companies are amazing. And I think we can learn a lot from these players. You know, Silicon Valley is much more advanced. They've been doing this for 20, 30 years before Europe really had a vibrant ecosystem. And I think that working with these players, also a lot of us learn a lot of things. I think we all expand our networks. And, you know, they bring a level of capital, which is unprecedented. You know, the amount of capital some of these firms are putting in companies, there just aren't today big enough funds in Europe to meet that challenge. But these can also make our companies champions. So, you know, whether it's a 10 million check from a local firm or 50 million check from an international firm, that can really change the game for the company on a global scale, which also brings a lot of capital and jobs into Europe, and also brings a lot of tax revenue. So I'm fully open to all of these international players from everywhere, from the US, from Japan, from China. I think it's great. It makes everyone get better. Competition is good because it makes everyone work harder and be better. So I'm fully open with it.
But absolutely, so we have the capital. So do we have the other necessary ingredients to come up, you know, regular with global winners? So is there a special tech or industry expertise we have in Europe? And for sure, we also need to have the founders for that. I mean, it's now we want to build, you know, lots of billion euro plus companies, or so-called decathlons even. You know, 10 years ago, we were looking at founders with a nice tech to build a 50 million company. So are we living up with that in the ecosystem?
Well, we've never been short of talent in Europe, huh? And tech centers. There's plenty of publications out there for those following the state of the European tech market, which is published each year jointly by Slush and Atomico. There's the 2 or 3 years ago, 5 of the 10 leading STEM schools worldwide were in Europe. So what we've historically been missing out on is the willingness of some of these talented people to actually go out there and set up their own company on the basis of good brains and good inventions that they were making. So still in AI, most of our top AI talents, they're recruited away by some of the global players in in the industry to become head of AI at one of the large corporates. So I think for me, it's never been a lack of talent or research centers or universities. We have plenty of that. I think it's now we see the combination of people coming out of these research centers wanting to do something with the ideas that they have and to set up their own company. In the past, there was perhaps the past saying 15, 20 years ago, you may not have had the funding. Now you will find the funding, and you don't necessarily need to cross the pond to get funding for your idea. So I don't think that's a problem that we have. And to your point as well, only in 2017, I think GP Bullhound was publishing the report on the tech titans. Can Europe ever generate a tech titan? And a tech titan was defined as a $50 billion company, and they were referring to the Ubers in America and the Ant Financials in Asia. And we didn't have anything like that in Europe. And now, 3 years later, in the midst of one of the largest global crises that we've seen over the last decades, we have Adyen trading at 60 billion euros. We have Spotify trading at $60 billion. We have plenty of decacorns like Otto One, Zalando, Delivery Hero, HelloFresh, all trading well above $10 billion. And this in the midst of one of the largest crises that we've witnessed. So I typically like to quote Churchill on this one. Never let a good crisis go to waste. So let's use this crisis really to make the publicity for the returns and the maturity that European venture can bring, because it is really out there. And if there's one thing that American firms are really good at, it's being a truffle pig, finding the truffles and the returns. So if they're sniffing around here for the truffles, it's because there are truffles. It's not because there are none, and they're trying to find truffles where there aren't any. So I'm quite convinced that we're only seeing the beginning of the full potential that European venture can deliver.
Okay, maybe we get to that just briefly, Stephan, regarding the ecosystem. So do you find enough talent to recruit, or is there a war of talent, so large that may be a problem to grow faster? So we have capital, but we don't have the teams.
Ingo, come to your question in a second. Maybe one comment to Bjorn to your points is, I think it's very well connected, right? So when it actually, I think there are a lot of founders out there which have strong ambitions to build quite larger companies, right? But on the other hand, it's also very linked with the capital, for example. So now when more capital pushes into the market, right, it's also that you as a founder see, okay, maybe I have really more access to capital, so I can build stronger ambition to build larger companies. So I think it's very well connected, capital and ambition level. Due to that also, I think we will see in Europe larger companies. I mean, you can also feel that currently, I think it's also a trend probably through this Corona topic, that more also US investors, but actually all over the globe can reach out directly in a digital way and try also to connect to the founder, for example, in Germany or somewhere else in Europe, and building the relationships. And so I think it's actually the ecosystem and the funding, the investors are reaching out a little bit more globally, and more US investors come also now and reach out to German or European founders. And that actually, I think it's definitely a very good thing, because it just creates, I would say, every network creates further opportunities on that level. So maybe that's
Yeah, I'd like to comment on the ecosystem talent thing as well, Ingo, because I think that the most successful companies in our portfolio are the companies that recruit talent on a global level. So if they need a VP product, they will search not just in their home country, but outside. And I think the good talent globally will look at opportunities also on a global basis. So, we have companies in Berlin that have people from Sweden, from Silicon Valley, from Eastern Europe, et cetera. So I think those are the companies that are going to win. I think the companies that are focused on only having people from their own home country and not having an international perspective, I think will have a much tougher time to compete on this global basis. So we're very much in favor of companies that are from day one trying to be international with their teams, because I think that's the way you get the best talent to your company.
Absolutely. So maybe Ingo, also I can just strengthen that comment. I think it's actually necessary, right? Because when you really reach out for the talent, I mean, when you, for example, look in the software engineering space in Germany, right? It's completely empty. So we have to reach out and pull in people from all over the globe, right? So I think, especially from our side, for example, we have 20 different nations and probably 20 people reallocated to Germany already, because otherwise you can't fill up your positions, because everyone is recruiting in the same areas, right? And I also see that, I mean, it enables actually to reach out globally currently, and every company should do that. So we should not only focus on Germany and Europe and discuss it more on a global scale, I would say, as well.
If I may just, Ingo, if you may just on something that Stephan referred to, the ambition factor. It's another soft factor, but it's such an important factor, and it's something that we have seen a dramatic positive change in the European VC sector as well. 20 years ago, when VCs were trying to raise money and they got funding, it was like, okay, let's now manage the money with an aim not to lose the money. That was a bit the behavior. I'm not investing in VC funds for them not to lose the money. I'm there for them to maximize the money. And now that's the behavior that we observe at the firms like you. But we also see that same ambition level at the entrepreneurial layer. So not only at the GP layer, but also the entrepreneurs themselves that are less and less willing to sell off a company too early. And that is a massive mind shift. You cannot create global winners if you want to exit your company too early and not take the next big thing. I don't want to dwell too long on it, but the ambition level that you referred to, Stephan, is according to me a fantastic element that we have observed in the European venture market.
Well, I mean, overall speed has become a massive thing anyways, right? I mean, if you look at how quickly sort of rounds have been raised from a seed round to A, sort of the average time frame that a good startup takes today, and then from A to B has, I mean, comparing it those time frames to the time frames 10 years back, it is massively down in terms of how much how long those companies need to stay during those rounds until they get back to the market and will raise new funds. And then if you take some very extreme examples on companies that are really on the extreme fast track, the UI path of the world, and if you look at the numbers and what the sort of most recent rumors around the pre-IPO valuation are going to look like, and then what a potential IPO price is going to look like. I mean, this company is how old is it, right? That it's a 3-year-old now. So that's totally unforeseen. I mean, we've never had that. Speed has sort of collapsed to a degree no one would have seen. To your point earlier, Bjorn, on the GP Bullhound statistics, all the pessimistics about Europe have completely been contradicted, and it's just I actually do think that the COVID year has even brought Europe closer to the US in the sense that even more capital is flowing over to the US, and there's an equalization factor. Even if you're in the Silicon Valley and you have to jump on a video call, it doesn't actually matter so much whether the other person that is currently in a pitch situation vis-a-vis a GP is actually based 5 blocks down in Palo Alto down the road, or whether that person is sitting somewhere completely in a completely different part of the world. The equalization of that phenomenon is fantastic, and it's really gonna help Europe even further to raise capital globally. The only part where I am still slightly concerned actually is the somewhat later round behavior in Europe, and that is one thing. If you take the amount of people that will not get fired out of a European GP writing a 50 million check that goes wrong, that don't have to sort of be concerned about their career, I think there's probably in Europe there's less than 10% that would be in such a position. So we need more of those. We need more later stage capital. Also has been said in prior parts of the conversation already. It's great that we are seeing it globally floating in from Asia, from the US in particular, but we need more European growth capital initiatives, more European growth capital funds. I mean, if we did market mapping, and if we look back how many GPs we had on the European growth capital market map, so we had less 2012 to 2015, we had less than 40-ish or so institutional quality GPs. That number has increased slightly. We are certainly not at the same level, but at the same time, the earlier stage institutional quality type of funds have quadrupled, quintupled, and nowhere near has the amount of institutional quality European growth capital GP. So there is massive room for growth, and we are all looking into good and appealing new teams being out there to hunt for the best deals and be in a competitive situation with capital from around the world.
Let's move to the actual performance. By the way, to the audience, I haven't seen so far any question from the audience yet, so that's your task to type something in. But in between, so things are going actually well. I mean, that's everybody can see that. But to Holger and Bjorn, to what extent do we see this in the fund performance? I mean, a couple of years ago, we've seen the fund multiples going up, with nice market valuations and selectively exits. And many LPs, or those who did not allocate capital to the asset class, still were blaming us GPs, well, you need to return money. Can you share with us the actual performance? Is venture capital a profitable asset class already now? Also, on the one hand, of course, the multiples, but also in returning money to you guys to make you and the pension funds and the I don't know, in Alabama, the policeman happy.
Well, I think Cambridge has the global data. At TIF, we would have very good data on Europe. There's a variety of elements that I can bring to the table. Just to name some numbers, for most of the vintages, the first 3 quartiles generate a profit for most of the vintages in Europe. So you don't even need to be good at stock picking, so to speak. It's going to be more difficult to find the 25% loss-making funds than to find the 75% profitable funds. So this stigma that we have that European venture is a loss-making thing, that's factually wrong. There's data out there that shows that's factually wrong. Now, given that we're all claiming to be the best stock pickers, if you add yourself a couple of selection skills, you can go into the top quartile managers. And in Europe, if you select the top quartile managers, you will be facing returns that are similar to what you can find with the top quartile in the US. I cannot slice and dice enough to know what the top 1% in the US is delivering, and then there's the question whether you have access to them. But in Europe, if you're investing in a top 25% managers, and speak to Cambridge, speak to us if you want to know who they are. There's people out there that can help you identify them. We have some of them on the panel as well. So, so feel absolutely free to reach out. But you'll be doing well, comparatively well. You'll be seeing good double-digit net IRRs. There's one element I want to, before I would hand over to Holger, also on multiples. 10, 15 years ago, I was jumping off joy when I saw a manager returning 2 times net. Then that number is starting to creep up to 3, 4, 5 times net now. Some of it already DPI, a lot of TVPI, still a lot of cash value. Do I need to wonder that it's all paper-based for many of them and not yet cash-based? I'm not worried for the time being, because most of the time when it's converting into cash, it's converting at a higher multiple than the book value that I had. So point in cases, perhaps the Otto One exit as well. I was very happy to see an email from Nenad come in with the end result and to look at the stock market price, because it's okay. There was still a positive surprise in there. And now I start seeing managers, people have been referring to UiPaths and others. I could name 2 or 3 other breakthrough companies in Europe where the managers are telling me, Bjorn, if I'm not making 20 times my fund, I'm going to be disappointed. I'm saying, what? And they said, if I'm not making 20 times my fund, I'm going to be disappointed. I said, well, can I quote you on this? Can I write it down? Yeah, they said, because I don't see how this will not happen. Actually, by the way, I'm actually more hoping for 30 times than 20 times. So that's the type of discussion I'm starting to have with fund managers in our portfolio. Everybody knows a bit, well, everybody, we sometimes put out our top 10 or top 30 or top 100. So up until now, the highest TVPI, DPI that I'm showing on public data that I'm allowed to hand out is somewhere at TVPI, DPI around the 13 or 14x mark. But even that is a matter of time now before that's going to be exceeded. So those are the levels, and I'm not just talking about one fund that will do 20 or 30 times. I can think of at least a handful already that with what we see now will start moving into that direction or beyond. Does that mean that I'm not happy with the 3x? No, it's always an outlier business. But where traditionally we were thinking, hey, well done, GP, you've returned 2 times the money. In order to impress us, you already need to be closer to the 3x or the 4x net to make us really feel impressed by your return. That does not mean that we're snobbing a 2x. We're still hoping to see a lot more 2x's in Europe as well, net. But that's a bit the environment that we're operating in. And if I compare that with what I hear from some of the US fund of funds, I don't think that our criteria are that different. But Holger, I've spoken too much. I think you have.
Yeah, so funny you mentioning it. I was actually on a call earlier with a pension fund, and so we had a bit of a catch up in terms of how things have shaked out around COVID, and they were curious to learn about the nuances, how the different quarters have performed, and how things have developed. And I'm super conservative type of pension fund, so not the typical VC type of go-to address that you might think of. So we had prepared a couple of charts showing also how the different venture capital areas have performed throughout the crisis, putting them next to buyouts and other private market type of funds. So there were like Asian numbers, just to steal my thunder here. Asian year-to-date private equity venture capital is up 29%, right? So that is 2020, beginning 2020 to end of 2020. So all of 2020, almost plus 30%. Europe, second strongest area within the world of VC within 2020 during the COVID pandemic, up 25%. And for the US venture capital, it's only 19%. So the US actually, comparing Asia in US dollar terms, Asia, Europe, and the US has, although they have massively sort of gained as anyone else and globally in the world of VC throughout 2020, is only coming in at the bronze medal. So that is super interesting to see that the non sort of at the forefront of your mind type of regions have outperformed the US during the pandemic. And so we were getting back to the pension fund and asking them, hey, how do you think actually how the year went? I mean, they had of course they have a very sort of mature PE portfolio. They have other type of private market funds. And what do you think? What was the real winner of the crisis? I mean, like within our team, everyone would have bet. They would probably think about US buyouts as the most safe bet type of investment, and they were smiling and saying, well, certainly it's going to be venture capital. So no surprises there. There's no longer even a secret to be told, is my message. Even very conservative continental European pension funds that have not dared to talk about, to touch venture capital are now having or starting to have internal discussions, especially given the crisis resilience that we've seen now in the area of global VC globally, to do venture capital, which is super interesting because that would add additional sort of liquidity to the system and make the ecosystem even more resilient to what might come at one day. If those discussions are really turning into the direction of really setting up VC portfolios, because so far most continental European large-scale conservative type of investors, let's put family offices aside for a moment, have actually not done venture capital, and that is about to change, which I find one of the most exciting and most interesting things over the past 12 to 24 months, that people that have never considered investing into VC are now starting to consider it, which I personally think, and I've been in this industry for 15 plus years now, but these past 2 years have been the most sort of, best rewarding is probably the right word. We having always pounded the table for 15 years for venture capital, European venture capital in particular. Now that people are really seeing the benefit and the joy, and also getting the returns on top. So it is just fantastic to see that.
I think that's very important what you're saying, that the sources of capital will broaden, get more diversified in Europe. Are there other institutions also moving more into the asset class? I mean, the pension funds, of course, would be a big impact. Are there others? You see that?
You mean outside of geographic wise, or like institutional wise?
European institutions going into the asset classes, but maybe also attracting more international money into European GPs.
So I think that is, being at Cambridge, we try to really pick the best fund managers globally, and part of our journey has always been to pick the best, as we think, the best bunch of ideas in Europe, at least a subset of that, and then bring global capital to those funds. So there has to be perfectly candid. There's always some sort of a homeward bias. I think it would be not fair to say that a U.S. endowment that has been an active and successful venture capital investor would primarily think about U.S. venture capital doing investments, given the maturity of the ecosystem and the decades of successes in many instances. But having said that, the like 10-year perspective, the bar was extremely high, and there was a very small subset and a very select number of European-based fund managers that would be in the position to attract global pools of capital, and that hurdle has lowered massively. And the amount of GPs that are in a position to attract global capital has, exactly for the reasons that have been mentioned earlier, has been lowered tremendously, and the hesitation from non-European investors to invest into European capital has massively reduced. It's not zero, so it's still like it's not the same. Being a U.S. state-run pension plan, you would not see the opportunity set or the likelihood of investing into European venture capital the same like investing into a well-known U.S. brand name. That's for sure. But net, I think if you're doing a good job as a European GP, you're in a position to raise capital globally these days if you do your job in terms of fundraising right, if you have a good track record to show, a good network to show, and maybe a good amount of early exits. I think that you're in a good position to raise capital globally, and we've seen that in the past. Teams that have not been around for like 7, 8, 9 years ago are now in a position to have at least some parts of their LP base is international, or international by that I mean non-European.
Okay, this brings us also to some of the questions we have. How's the fundraising situation for GPs? And we ourselves, as UVC, have experienced launching a new fund in the pandemic. Was a bit. We thought it's not a good idea, but we did. We needed to do it. And after the first couple of slow months, we had a very strong traction. So the LP market did open up quite early, mid last year, to allocate capital again. So how do you see the fundraising market for GPs? So is it looks like when what you're saying that we are back to normal, or even due to the good performance, we are better than it was 2 years ago. And how is it for first time for emerging funds, maybe also in emerging countries? Can you explain a bit the background there?
Sure. So fundraising was tremendously, as well, deal volume was tremendously down in early 2020 in particular. So fundraising was really getting difficult. There was a bit of a bifurcation, a very, very small select number of names was in the position to do business as normal, but that was really the exception rather than the rule. Also, not every investor is still 100% back in terms of making decisions online. So it's a minority, but some investors are still like pushing out allocation decisions until like hopefully second half of the year when they can meet physically. It's really very often that they have made up their mind, but they really want to meet in person first. So I wouldn't say that this money is sort of gone or is going to stay uninvested. It is really about like the point in time on when you can meet again. That people would go back. And so for 2022, if things are going to stay the same, or the second half of 2021, I personally do think that we are back to pre-COVID levels, if not above. That's a good message. When it comes to emerging manager, that is actually a very interesting question. So we are seeing that is not a VC phenomenon generally at the moment. We are seeing a select number of new teams that some of them were actually in the position because they're coming out of very well-known sort of existing setups and brought their network both on the deal side as well as on the LP side to raise capital relatively quickly. But overall, in terms of new teams being founded, being set up, the first-time team activity is down quite a bit, which is a broader phenomenon across different sort of segments of the market. I would that is something we are observing very intensely, how that is going to pan out. But for now, I would say this is a bit of a sideward movement. Nonetheless, the new teams have been in a good position to raise capital overall.
Yeah, I'd like to comment on the fundraising. We launched our fund in February 2020, our Fund 5. So we've been going through fundraising during this period. It's been quite an interesting road. I would say the first couple of months were definitely tough. We did manage to get our first close last June, thanks to some of the people on the panel here. And now we are coming towards the end of our fundraise, and we're 80% committed, and I think we will be oversubscribed in the end. But I would say it's doable. It's not. I wouldn't say it's a slam dunk. I think that a lot of LPs that invest in Europe are still, focused on some of the old legacy brand names that started in Silicon Valley, as well as one particular one out of Switzerland, which has just knocked it out of the park, and chapeau to them. But I would say I think European venture is still, something people have to work on. A lot of the big traditional U.S. venture investors are still a little bit hesitant to invest in European venture, and I think that the work that EIF does is tremendous. And if we can get that message out there, I know Klaus from Lakestar is a big proponent of getting the message of European venture out there, because the numbers are there, but I think a lot of investors are still, especially U.S. investors, which are the biggest investors in venture capital globally, if we could get more of them to open up, and obviously open up the pension funds in Europe, which has started to happen. And we got a big pension fund allocation in our Fund 5, those are the type of LPs that move the needle. One thing we see a lot of in Europe is, these investors or LPs that are really GPs in disguise. So they want to invest in your fund, but they want like 3x the co-investment. And this is, seems to be the trend du jour. But we're all running businesses. We have to pay for offices and pay for our staff as well. So they don't get it that we have to actually run a business as well. We can't just give them free co-investment. So I think that is something that is challenging. But I think good investors, we like keeping our funds smaller. So actually, we do offer a lot of our LPs co-investment so they can actually reduce their fees and carry, and also speed up their returns. So I think that is the flip side of raising big growth funds, is that we can also do a lot of SPVs and have the same effect.
So one question Sorry.
We just have a few minutes. Maybe to address a couple of the questions in a few minutes. There's one question about impact investing. So maybe Bjorn, could you briefly state on that?
Yes.
How do you see impact investment funds or ESG, but also the relation to the return?
Well, I was actually going to start by that one. Many people seem to say that if you do one, you cannot have the other. Whereas if you look at the Sustainable Development Goals, they're actually goals that tackle issues that are relevant for the whole planet. And I cannot think of any other industry that is actually for decades trying to solve humankind's problems than the venture capital industry in terms of financing the innovation that solves problems. And also here, if we all agree that sustainable development goals are something that needs to come if we want to have a livable, sustainable planet. I'm not only talking about climate, but there's many other things that go into the SDGs. But I don't see why technology that actually helps us to achieve these goals would be developed at the cost of a return. So we actually think that SDG investing, impact investing, tech for good, is not a way to compromise on the returns. On the contrary, we have dedicated impact pools where we go even as far as linking the carry that fund managers will get by achieving the goals. And we have models that track, if you have the KPIs that go with it, actually the KPIs that you need to track to whether you're achieving the SDG goals are the same ones as that you would track to make certain that your business increasing exponentially in value. So it's ways that we need to get rid of this feeling and thinking that if you go in the ESG route, that therefore you will have lower returns. No, they go hand in hand as long as you tackle the right problems.
Maybe also one comment from my side, from the founder perspective, founder view on that. I think we will see more ESG conform investments, because also most entrepreneurs get entrepreneurs because they want to change something, right? And I think in general, it's also true for myself or for us, why we founded TWAICE. But it's really when you want to make a difference, probably most of them want to do it for the better. And so that finally leads to that the topic that more companies will come up with are related to climate tech or other sustainability or environmental sustainability topics. So I think we will see more companies in that area. And on the other hand, I think I just quote this Larry Fink quote from him, as he said, there will be a strong reallocation to this sustainability topics. I think that's probably true for the next 10 years, because we all have to do the right things to live on the planet for the next 20, 30, 40, 50, or 100 years for a better. So I think I think that we're all in the same boat for that topic. So we will see that strongly, I think.
Unfortunately, we need to get to an end. We have a couple of questions outstanding. Maybe I try to briefly address a couple of them. One is a question about the valuation development over the last 10 years, whether European tech is getting expensive. Well, I can tell you 5 years ago, I was concerned when valuations were increasing. Today, as valuations are even higher than I'm not concerned or hardly concerned. It depends on the specific company. Sometimes the valuation is too high, then we don't invest. But in general, we see that companies are growing to a size which was unthinkable 10 years ago. So the entry valuation compared to what the potential outcome is still low if the company is successful. So I'm not concerned about valuation, and that if I'm not concerned, that has to say something. If the whole economy busts in a couple of years for weather reasons, then we have another problem. But I think the system is healthy here. And there was another question about having the startup, the GP, the LP, and the ultimate investor level, how that chain of money would work. I think that's too complicated to answer in the words. It is a chain of money, but as long as the ultimate, I mentioned the example of the policeman in the US, who depends on his pension money, what he paid. If he makes money, then everybody makes money, and that has to be the target. And for the current time being, it seems like the model is working. But you need to ask some of the people here how it works in detail, separately, offline. I think we just have a minute left, and we may be cut off sharply. So I think we need to stop here. I want to thank the panel very much for the valuable insight, for your experience. Thank you to the audience. I need to say a couple of words about before we break up here, because there will be a questionnaire, your survey you're asked to fill out afterwards. So when the session closes, there is the opportunity to give your input on the session, and it would be great if you find a couple of minutes to do so. In general, I think thank you everybody for participating. So I hope it was interesting for you and helpful. Goodbye and stay healthy, we need to say in these days. Bye-bye.
Bye-bye.
Thank you. Bye-bye.
Bye.
Bye.